All right, in this lesson, we're going to take you through a quick example of how we just do the journal entries for bad debt. I know you know what the entries are from the last lesson if you watched that one, but let's take it into an example and show and walk you through what that entry is going to look like. Again, I'm going to give you all the amounts. However, in future lessons, we're going to show you how we calculate the amount. So this is a very simplistic answer just to get you understanding the entries. So let's take a look at our example prop. It says company A has established an allowance method for their credit sales based on an advice they received from their CPA. Accordingly, their accountant has informed the accounting manager that they should book $20,000 for potential bad debt based on a percentage method of net sales. So they took net sales and they multiply it by percentage, and that's how much bad debt they're getting, $20,000. In addition, 2 weeks later, the company incurred $3,000 of bad debt from a customer who went bankrupt. So now they know the customer's not going to pay because they were bankrupt. So we need to book the $3,000 of bad debt and write that off our books. Okay. Prepare the journal entries for the bad debt expense and the customer's inability to pay their balance. So let's start with the first one here, when the sale occurs. So when the sale occurs, we have to include a bad debt expense, and then we got to put that money. We're not really putting the money in the cookie jar, but we're putting that money into the cookie jar for when bad debt actually happens. So we know that from our last lesson, we're going to debit bad debt expense, and we're going to debit bad debt expense for $20,000. And then we're going to put that money into the cookie jar. So we're going to credit the allowance for bad debt, $20,000. So it's going to look something like this. Bad debt expense for $20,000 and credit allowance for bad debt for $20,000. So that will be our entry when we make the sale. Okay. Then we kind of move our way. 2 weeks later, we find out that a customer doesn't pay us $3,000. They go bankrupt. So at that point, we know that the chances of us getting any money if they're bankrupt is pretty low. Not to say it can't happen. If they go through bankrupt proceedings, we may be able to get a portion of our money back, or we may be able to do some negotiating because they really need our services or our product in order to keep on going into the future. So there may be some negotiation, but at this point, we don't expect that money back because they went bankrupt. So because we know this, we're going to write off their entire AR balance. Their entire AR balance right now is at $3,000. So to do that, we pretty much have to take the money, although it's not money. We're taking the money out of the allowance jar, and we're going to extinguish their accounts receivable. So to do that, we need to take it out of the allowance. So to take it out of the allowance, to put it in, we did it a credit. So to take it out, we would do the opposite. So we're going to debit allowance. In this case, $3,000, and we're going to credit accounts receivable for $3,000. And we are crediting their accounts receivable, which also means that their accounts receivable right now is zero. Like I said in the last lesson, we then take that information in some way, we keep track of it. That way, if the customer comes back to us, we may demand that $3,000. Now, if they go through bankruptcy and the judge extinguishes it there, then we can't go back to them and ask for $3,000. We just have to treat them as a new customer at that point and do our due diligence. And the next time, maybe not extend any credit, but the only thing is cash on demand. So in this case, we're going to keep track of the $3,000. We know we're not going to get paid. They're going bankrupt anyways. The judge is going to extinguish their debt anyways. But we'll keep that just in case that doesn't happen. But now in our books, they owe us $0. So that is a simple example of a bad debt example. I know I've given you the numbers, and all you have to do is just copy the journal entries. But the key thing here is to understand the journal entries so that we start learning more things on top of that, which includes calculating that $20,000 and how do we go about doing that. So until then, hope you enjoyed this lesson. We'll see you in the next video. Hey guys, if you like this video, make sure you press the like button below. And if you're looking for worksheets that go along with all of these lessons, head over to my website at patrickleemsa.com or clicking the link in the far right. And I've got your next lesson right over here. So just click that link and it'll take you to that video. So until then, we'll see you in the next lesson.